All right, so we continue with our conversation. This is part 2 of the investment opportunities episode. We have talked quite a lot about money, understanding money. We've gone through what capital markets look like. We've talked about risk. So now we want to go into the actual investing itself. Why do we invest? What is the bigger picture? And again, of course, Timothy is going to be taking us through quite a number of concepts. And it's important for me probably to ask Timothy, with investments, where do you start?
Good question. And that is a question that I've always looked forward to answer.
Yes.
Because it's a question that always comes up. Now, when it comes to investment, remember what we said. You have to define your destination.
Yes.
The objective. What do you want to achieve? But even before I go there, is to say that at any given time, I can classify the 3 broad goals of investments into 3.
Okay.
Number 1, there is liquidity.
Okay.
Liquidity goals. You want to be liquid because you want to pay your expenses, you want to pay your bills, you want to pay the obligations when they fall due, whether it's your own or the school fees for your kids or your university
premiums,
or insurance premium.
Yeah.
Those are liquidity goals. So there's a part of investment that then you're required to be liquid. Yeah? And most of the times when you're starting in life, that is the main goal.
Yeah.
Because you don't have like a huge pool of funds that then you're trying to put in the long term. So a lot of your investment will be tied in the short term, which is liquid. So that is number 1 category, liquidity. Number 2, accumulation. When we go past liquidity, when we have settled our bills, when we have paid our school fees, our insurance, we have gone for holiday, what is the next? We want to save the buffer. What remains? Yeah, we want to save it for the future because we also want to build wealth. It's called accumulation. That is a wealth building goal. Yeah, accumulation. And then once we have accumulated, then you go to legacy. And it's because a huge amount of the wealth you're creating will outlive you. So you need to be cognizant of the legacy part of it. This is the most possibly spoken about topics in terms of from a retirement point of view, but I also find it missing because the advice of retirement does not go beyond then. How do I handle that part of my life? One of the advice and conversation I have had with people is that you need to do what we call consolidation. You have accumulated, yes?
Yeah.
Now, when you are in your late years, you need to consolidate. You need to deaccumulate. You need to shed. Shedding does not mean wasting money. It means that you are doing what we call estate planning. That you want to leave your wealth in a form that can be handled by someone else, that can be taken over by someone else. That is decumulation. You want to consolidate your wealth in a form that can be transferable. There are things today, and they are part of your wealth today, that only you who understand how it works.
Yeah, very true.
It can even be a business. You have a business, not your wife does not understand what you do. Your husband does not understand what you do. Your children does not understand what you do. So in case anything happened to you, who do you leave that business to?
Yeah,
they don't know.
Continues running it.
Exactly. Yeah. And so you have to do some transitional mechanism so that the form in which you leave that wealth is in a form and shape that they can manage. It's called consolidation.
Okay.
Some of you have possibly lands and apartments and real estate that is far away, even no one knows where it is. It is to ask, is that form you're leaving your wealth, or the current form, is it a form that can be transitioned to another person? And if it is not, it is to put it in a more simpler form. You either sell that company or a stake of it. Okay? You either orient your family into it.
And orienting, you're assuming they're interested in it.
You might find that there's no one of your children or your dependents who want even anything to do with it.
Yeah.
Exactly. So you want to put it in a shape that this wealth will be transferred to my children, they will be able to handle it. So what do? If you're in that kind of business, you want to reduce your stake in it. You can either sell, okay, so that then you leave this part of wealth, the proceeds from that sale, then you can put it in a wealth in a way that can be managed by the dependents. Yeah. Okay, so that is legacy. That is legacy planning. It's part of estate planning. Then we got inside here, and so there's liquidity, there is a legacy. That one we'll talk about later. But now let's go to accumulation. You have to have vehicle that you can use to accumulate wealth. Okay? And so when we talk about, we need to understand the objectives. Then you need to know which section you fall in. Someone who is accumulating might use different investment opportunities to someone who is in legacy stage or someone who is in liquidity stage. And those are the investment opportunities that we are going to talk about.
Yeah.
So that when a stranger comes on your road and tells me, Timothy, there is this opportunity, I have to ask myself, does this fall within the realm of the objective I'm trying to achieve?
Yeah.
Because like clothes, they don't fit all. So does it fit in your goals? Because if you don't want to be disappointed, and I've always said this, the reason why a lot of people are disappointed and frustrated by the investment they take, it is not because the investment was bad, it is because they mismatched.
Yeah, mismatched.
The objective
With
and the opportunity
vehicle.
they took.
Yeah, true.
So that if you're on the liquidity section, your goals are liquidity goals, and you go tying that capital of yours in land. When you want that money, it will not be available and you'll be frustrated.
The process of liquidating
The
land is
nature of
not...
that investment does not suit your goals.
Yeah.
And you have to be very clear on that. If then you're accumulating again and you go to liquidity, you'll suffer something called opportunity cost.
Yeah.
Because you are holding a lot of money. Because what also happens is that depending on the outlay of the investment, longer investments most of the times have a higher return than short-term investment. And so when you're so much concentrated on the short end, you are and this investment will go for a longer period, then the differential in terms of the earnings, you are leaving it on the table.
Yeah.
Because you are putting, this is a 10-year investment plan, you have an interest that is way lower because you are packed all your money in liquid instruments, you are leaving a differential of maybe 3, 4, 5% that could have been critical in building your wealth.
So I think also, Timothy, it's important to mention at this point, even as you talk about liquidity, then I think also that brings in the factor of time, like the horizon, the investment horizon you're looking at, because that also is going to very highly determine what particular investment option or vehicle you decide to choose. Because naturally, and as we continue to discuss the investment vehicles, you're going to realize some of them are short-term, some of them are long-term. And you'll notice most times are not very long-term investments, then their liquidity is also quite questionable. So it's good to be very clear. As you look at your objectives, also it's good to look at what is your time horizon. For how long do you want, for example, to invest? But of course, anything that is liquid, then it means that you also are intending to use it in the short-term horizon. So it's good to be very clear on that.
Exactly.
Yeah.
And so I've always said this, that if at any time you need your money and you can't have it because you want to sort an obligation, you can't have it, then it speaks volume in how you made your decisions.
Yeah, true, I agree.
Money is of no value if whenever I need it is not available.
I cannot use it.
Why am I even earning it in the same place? So it should serve me, but I'm trying to argument it into a way that it serves me the best, it gives me the best optimal value. That is what we are trying to have this conversation. And so we need now to go to the investment opportunities. Having understood the investment goals, the investment objectives, now we go to the basket of opportunities.
Yeah.
And I want to start by this. Opportunities are in thousands.
There's an
Here
array.
we're just touching the water, just the tip of the iceberg. The iceberg is big. And we cannot exhaust the amount of investment opportunities there are. But having discussed in part 1 and even what we've discussed now, at least right now, you're in a better position to evaluate whether an investment is suitable. Because suitability is a key element when you're evaluating investment.
Yeah.
It's like a cloth. It is not how it looks on the mannequin, it's whether it can fit you.
Yeah.
So suitability, does it suit your circumstance? Does it suit your objectives? Does it suit your risk appetite? We talked about risk. And then that is how then you choose one and leave the other. Because in a sea of all these opportunities, it will be difficult then to decide which one do I pick and which one do I leave. The one to pick and the one to leave will be determined by your investment objective.
And Timothy, it's good even as we go to the investment vehicles, because then we are going to talk about a number of them. One person could have the 3 objectives that you've spoken about. Someone could be looking at, I want to create liquidity. I want in another place to do legacy planning or what you've called consolidation. And maybe also I want to accumulate wealth. So again, it's important to know that then if there are people who are just going to work with one objective, but there are some of us or you who find yourselves with wanting to meet all objectives, then that will mean that for yourself, then that will mean you probably might need to do a number of investment vehicles, because different investment vehicles will meet different objectives. It's good for me to mention that.
That is very beautiful, because it means that you have to segment your wealth.
Yes, that's where actually I was going with this.
You have to think about it from that, so that you have pockets of each.
Liquidity, pockets
you have liquidity,
yes.
You have accumulation.
Yes.
If you are old enough, then you're also doing some legacy planning. It is not that you pick one and say, this is my objective. No. Depending on where you are in life and where you are in terms of your age, your income, then it means that you will blend you'll have either or pick
one
2 of them.
Yes.
And so it is, and when even talk about legacy, we're not talking about an old person.
Yeah.
We're talking about things that then you can ensure that you very well understand they can outlive you and how to handle them. Now, when we come to investment opportunities, we are going to concentrate on capital markets authority. That is what we understand. I talked about financial markets.
Yeah.
And I know this country, as I said, that we have a tendency of, or we have a long history of investing in land. That is the only thing we know.
Yeah.
But as previously we discussed here, is that if you want to look a country in terms of development and the scale, how far they are in terms of development, look at how the citizens of that country invest. People who invest in immovable wealth
classes,
that country might not be very high in terms of the scale, wealth scale, because capital needs to be fluid. Because what financial markets does, it allocates capital to where it is most needed. That is what you need to understand about financial markets. It allocates capital where it is most needed. So if you have an opportunity that is not optimal and there's an opportunity that is optimal, financial markets helps you in allocating that.
So it means you should have some circulation of sorts.
That's circulation. But when you have like immovable type of wealth, it is not possible for you then to move it around.
Circulate around, yes.
That is why it is important to understand the financial markets. That opportunities will be suitable today, not suitable tomorrow. Opportunities will be attractive today, not attractive tomorrow.
We'll have new ones.
Yeah. And you have to have a way that you can then move the chips. That is why financial markets are important, and capital markets for that matter. As I said, financial markets also fall under category of regulated
and unregulated.
Yes. When you come to financial markets, the regulator in this country is the Capital Markets Authority. There is the Central Bank of Kenya. There is the Retirement Benefits Authority and Insurance Benefits Authority. All these playing within the financial markets, and they are all regulators. The thing is that they add a bit of some buffer in terms of your due diligence. They have done a bit of due diligence, not to say that whatever they have approved is not risky, but again, it gives you a little bit of some comfort that someone else has also checked that these guys are okay. Yeah? So when it comes to then regulated, we start with the most basic one, and especially on the liquid part of it, which we call collective investment schemes. Collective investment schemes, or they are called mutual funds in other countries.
Yeah.
That is a very good vehicle to start with. And in these countries, a lot of people know about
money market fund.
And so what is a money market fund?
Yeah.
You can think about a money market fund like a big chama. There's nothing, it's a lot of people pulling money together. And why are we pulling money together? Because in finance, we say small is seldom beautiful. There's something called economies of scale. That today, if I have 100,000 shillings, I went to the bank and asked them, can you give me a fixed deposit? They might give me possibly 5% on the fixed deposit.
5 is high for 100,000.
Or even 4%. Or they tell me, we cannot fix 100,000 shillings. We don't, that is too small money. Go spend it or just keep it in a normal savings account.
Yeah.
But if I walk to the bank and told them, I have 1 billion shillings, they listen to me. I'll be
able to negotiate.
And I'll negotiate that I want an interest of 15%.
Your money will speak for itself.
Exactly. So it says that then there is power when the money is huge. I told you small is seldom
Beautiful, yeah.
So you need it in large so that then we can be able to tap in some very unique opportunities that small amount cannot tap, but also negotiate for better returns. So what happens in a money market fund? It is a very liquid fund. Number one, money market tries to give flexibility in terms of access of money. It is liquid in terms of access, in terms of deposit, minimum entry amount. Okay. And what happens is that when we aggregate amount out of many unit holders, sometimes it calls a unit trust, because when you buy into a money market fund, your money are converted to units. So 1 shilling is equals to 1 unit. Yeah. So for all those unit holders that are in this pool, this big term of ours, the collective investment scheme, when we aggregate money, you are 5,000, another person 10,000, another person 100,000, this money will be huge. And then this money is given to a professional fund manager who then uses his professional understanding to scope for opportunities. But then the Capital Markets Authority, in their regulatory mandate, has defined on the investment that such money should be invested in, so that the investment manager does not just invest in anything. So what you'll find out is that there is a defined what we call asset allocation, that these are the only pre-approved assets for money market fund in this ratio. Why? Because concentration is also risky. So you want to make sure that the fund is diversified, but most of the times money market fund will invest in what we call interest-bearing financial instrument. They'll put your money into fixed deposit, into some things that we'll talk about called treasury bills, treasury bonds, corporate bonds, commercial papers, but all these are interest-bearing. The thing with money market fund, because of the liquidity nature of it, it requires that to put some portion, because in liquid form, because I don't know when you might come for
your money.
The money. Yeah. So it gives you flexibility, but also it makes sure that whenever your money is there, it is earning. So it is very important to understand that. So it is a very good vehicle, especially for the liquidity goals we talked about.
And also, it's good to mention that, like Timothy has said, one thing that is really good about money market funds and very accommodative is the cash inflow that you need to put. The starting capital for money markets is quite affordable. It's like, pocket friendly.
It's like some have minimum, depending on the issuer, some have a minimum of 5,000, 10,000, 100K, even 1,000, even 100 shillings. So it can be accessed by everyone. It can be accessed by everyone. And that is a very good point to start, because it allows you to achieve your liquidity goals, but also helps you understand investment and the markets, how they operate.
Yeah, and you can build up on it. And like, for example, if you are to go to other asset classes like real estate, in this case, mashamba, what we know of, it needs you quite a big chunk of money, like a lot of capital for you to buy it. But with money markets, you can always put in. And the good thing with money markets these days, you can do mobile banking, USSD, from your convenience. You don't have to go with cash and deposit, and you can always top it up. If you save something, if someone buys you a gift and you didn't want the money to use it or lunch, you put it there. So it also somewhat gives you, and the good thing is it's not like your normal savings account, because it's earning you. It's not like a current bank account. It's earning you interest.
Every day.
Yeah.
Actually, interest on a money market fund is earned on a daily basis. It is posted in your account like every month. So when you're looking at your balances every month, you realize there is that growth. And then it is compounded. Because the compounding is very important. So what you're saying is that the interest you earned in month 1 becomes part of your principal in month 2. So when the interest in month 2 is being calculated, it will be calculated based on the principal plus the interest in month 1.
So let's do this practically. So for example, if you put 100,000 this month and it earns 15,000, remember it's just a figure I have picked. For month 2, the interest will be calculated on 115,000. So when that 115,000 earns another, let's say 20,000, now it will be calculated on 135,000. So that compounding, because sometimes I feel like people say when you use those terms, you're using jargon. Compounding is basically how you grow. Your interest becomes part of the money on which the next interest is loaded on.
Good.
Yes.
Okay. Now, something else to note is that the way the capital markets regulates and the intentions of money market fund is that it is a low-risk investment. Not to say that you can't lose, but there is low probability of you losing. Because if you look at the instruments, it is very well guided by the regulator on the type of investment you have to invest as the fund manager, the person who makes the decisions to manage. Yeah. So that is a basic level of starting.
Yeah.
And within the collective investment scheme, that is the most known product,
The money
but there
market
are
fund.
others.
Yes.
So of the five known or four investment baskets in the collective investment schemes that have been approved by CMA, there is money market fund,
equity fund.
there is equity fund, there is a bond fund, there is a balanced fund, and there is a special fund. Those are five of them. So money market fund, I told you, it is a money market. So they invest, actually the name says it is a money market. They invest in money markets. Money markets are banks. They buy, they put deposits there and they earn interest. They buy treasury bills, they earn interest. They buy commercial papers. They invest in private companies that want to borrow, but not from the bank. They can borrow from it. It's called a commercial paper and such. So it's a money market. When we go to the equity fund, equity means shares.
Stocks.
That is stocks. That is the most common name that is known, shares.
Yes.
So it invest. These are funds that invest purely on stocks. Yeah, they can buy stocks that are listed. Whether it's Safaricom or any other stocks that you can think about. It depends on whether they are local or also international. So, but if you hear equity fund, it's investing equity investments,
shares,
or stocks investments. Then there's a bond fund. A bond, they invest in debt market. Debt is they lend money. It can be to the government, it can be to other companies,
private
or whatever,
entities,
and they get the interest and pay you. So that is pure. So then the name then defines the category of asset classes that they could invest. And then last we have a special fund. Special fund can invest in different type of asset classes, including commodities, including derivatives, including stocks. So it's a mixed basket. It's a mixed basket.
And the balanced fund?
And the balanced fund, then, it is then for, depending on the regulator, and this is in the context of Kenya, the balance is it creates a balance between bonds and equities.
And stocks, yeah.
And stocks. So you have a bit of some bonds and a bit of some stock, and there's guided allocation in how that should balance. That's why it's balanced. So you can think about it, you'll invest 50% in shares or stocks, and then 50% in bonds or debt
depending
market.
on what the investment policy statement says.
Exactly, depending on what the investment policy statement. That is the manuscript that the fund manager uses as a reference point to what asset classes they'll pick. Yeah. So that is what
money
we call
market
collective.
Fund. Yeah, collective investment scheme.
There are mutual funds. There are others that are called index funds, even beyond the borders of Kenya. Index funds are also pooled investments, and then you give to a fund manager. They invest in a certain style. Yeah, there can be, for example, the globally known index fund is called the S&P 500 index fund. This is a fund that has invested in all stocks in S&P 500. So whenever you're buying that fund or a unit of that fund, then you're buying every other share in that S&P 500. Yeah, and those index funds are listed funds. The difference between an index fund and an ETF is that an index fund is listed. Yeah, and in terms of even the management, it replicates an index. An ETF,
electronic traded fund, because they're wondering what is an ETF.
Yes, an ETF and a mutual. These are types of mutual funds. Yeah, so that is the gist
collective
of it. But to think is like where money is pulled together and invested.
Yeah. So, on that note, Timothy, I'm sure our viewers are wondering. So now you've told us about the different collective funds, money market, debt, bond fund, equity fund, the balanced fund, the special fund. So they're wondering, so how do I open such an account to invest in such instruments? So number one, we are not recommending any particular fund that you're supposed to go in, because remember we said it's a subject of one, what is your risk profile and your objectives? Yeah, but it's good to mention that, for example, in our country, quite a number of banks and insurance companies have that product. So in the business daily, we have a section where they actually list all money market funds that are currently in the market, and other funds, other collective schemes. So you can go look at it, look at what fits you, reach out to the companies and get more information, because we are not here to recommend a particular company or brand.
And actually,
yeah,
you've said something that I need to say. You see, those different funds, apart from money market fund that you have said is a low risk, the rest have a bit of some risk. I could call them they are
exposure.
medium risks.
Yeah.
Meaning, when we talk about risk in this context, we are saying that there is a risk of you losing your principal. As much as you're chasing the return, the only fund that has a bit of some low risk that you may not lose your capital or your principal is money market fund. Equity fund, bond fund, special funds, whatever other funds that we are talking about here, there's a possibility that you might lose. Yeah, that you might lose your money. So it's good to evaluate and to understand. So if you're risk averse, just invest in
money market
fund. And actually, that is the most common fund. When it goes to the other like index funds or exchange traded funds, we call them ETFs. These ones, most of them are globally. Although in Kenya there's a gold ETF that is offered in the country. I think we have one. We'll talk about that later. It's a commodity fund.
Yeah.
But then you have to understand what asset classes that those index funds and exchange traded funds invest in and evaluate. Most of the times, and I want to say this, that a lot of us don't have the capability of evaluating such things unless you are professional and beyond, finance expert.
Yeah, and Timothy, even beyond evaluating, some of those funds you actually won't have a view of how it's behaving.
Exactly.
So you might find yourself, if, for example, invested in an equity fund and you're not keenly following the NSE, you end up losing money. So
exactly. So it's good to really understand. I usually say this at the start: invest in what you understand.
Yep.
That is old wisdom. Agreed. Invest in what you understand. If you don't understand something, just put it in a money market fund. And the interest is not to say that since there is a money market fund, the interests are not as high. The interests are quite conducive, especially in this high interest environment.
Seasons, yeah.
You're looking at interest as high as 13%, 14%, 15%. All this. But just to note that interest rates or interest earnings in this country are subject to 15% withholding tax, apart from interest from certain instruments that we'll talk later. But that should not worry you. If you are left with your 13% net return, you are so decent. You are keeping the money. Remember, these are not tools to make you money.
At least you're above inflation at bare minimum.
Enjoy. These are not tools to make you money.
It's to keep.
These are tools to keep your money. So don't come here expecting that you'll double your money in 1 month. No. These are not tools to make you money. These are tools to keep your money. When you have made it elsewhere, whether it's in business, whether it's for employment, whatever you have made it, whether you gambled, fine. Now bring that money.
We are helping you to keep it.
We will help you keep that.
I agree. Yeah.
Yeah.
Okay.
Now we scale to what we call, and we are talking about the most common investment vehicles in this country.
Yeah.
Number 2 are called Treasury securities. Treasury securities, these are loans to government. The government borrows, you lend money to the government. And they're in 2 types. They are treasury bills and they are treasury bonds. The difference between them is actually the tenor.
Horizon.
So investment horizon. Treasury bills are short term, 1 year and below. So we have 3 categories. We have a 91-day treasury bill. For 91 days, those are like 3 months. We have a 182-day
bill.
That is like for 6 months. And you have 364 days.
Yeah, for 1 year.
When you invest, then you wait for the days and then it matures.
Yeah.
Then you go to the last one, the bonds. Bonds have maturities of 1 year
and above. Yeah.
It can be 2 years all the way to 20 years.
25.
Yeah. 30. Now, the way they operate is a little bit different, and that is where a lot of people don't understand. When you come to treasury bills, they are called discount securities.
Discounted papers.
They are discounted papers.
Yes.
The reason it is discounted is this. Imagine you have ever bought a discounted item, whether it's from the market or the supermarket. Something that was selling for 100 shillings, you buy at 90 shillings. So your discount is 10 shillings.
Yeah.
So that is how treasury bill works. So if you'll buy a treasury bill worth 1 million, but central bank will tell you to pay
950.
Possibly 950,000. So your interest is a 50,000.
There's a discount amount.
That is a discount amount, and it is quoted in interest terms. Okay, in percentage terms sometimes, but you can. The best way to understand that is a discount. So you're buying something worth 1 million shillings.
You pay less. That less amount is what is your interest.
Exactly. An important aspect to say that these treasury securities is where are they issued and where.
And when.
So the government, you have heard about the debt tuko na madeni. This is the loans we are talking about. This is one
That's
section of the loan. It's called a
local.
domestic
Yeah.
debt. Where the government, because of the tax lag between when we collect the money and when the government spends, there's a lag of time. The government needs to go and look for that money to pay before it corrects tax. Some of the taxes are corrected at the end of the year. They are called corporate taxes. But we need to spend. We need to pay teachers, policemen. We need to pay expenditures, recurrent expenditures. So we have to borrow to bridge that time gap. But even number two is something because of something called a budget deficit. That we want to spend more than we will tax.
More than we are collecting.
More than we are
taxes.
collecting.
Yes.
So if we are collecting 2 trillion shillings and our budget is
3 trillion.
3 trillion shillings, we have a deficit of
1
trillion. That is where the government borrows. So how does the government borrow? The government uses Central Bank of Kenya
CBK.
as the agent of correcting this. It is a fiscal agent of government. So the government, the Central Bank of Kenya will come and float whether it's a T-bill. And floating means that it is asking investors to lend government money. Either for treasury bills or treasury bills. Now, if treasury bills are issued every week, so every week there is a treasury bill, you can buy through your bank or through the central bank directory. The beauty with possibly buying through your bank is that they'll handle end-to-end transactions.
The logistical part of it.
Logistic part of
settling and all that.
Exactly, settling and all that. So that is how the whole market operates in terms of treasury security. So we have said treasury bills, they are in 3 categories, and they are discount securities. They are for 3 months,
91,
6
182,
months,
and 364.
and 1 year.
And they are
Exactly.
auctioned every Thursday, to be precise.
Exactly.
Unless there's a public holiday,
Good.
they communicate.
And so when you're defining your investment horizon, you need to be very sure of the investment horizon you're tapping into. Then we go to treasury bonds. Treasury bonds, we say they are long term, but they are not discount securities. Them they pay interest because they are long term. You'll buy a bond today, and then it will mature after 5 years. Maturity means that is when you will be returned back
The
your
principal
capital.
amount.
Between now and 5 years, you'll be paid interest every year, twice, semi-annually. And just to give an example, if you have 1 million shillings and you buy a bond, at assuming it doesn't even have a tax, you buy a bond and pays interest of 15%. So 15% of a million is 150,000. So this 150,000 you'll be paid every year, but they'll be paid in 2 tranches. So half of it after every 6 months. So you'll be paid 75,000 and then 75,000 again. So you have 75, 150 up to the year 5, and then the 1 million will be refunded back
at maturity.
Yes. So those maturities differ. Maturity can even be, I will say, it can be a
5-year paper,
5 year, 10 years, even 25 years. So that is very important to differentiate. And so when you're picking this instrument, it's good to define what you're doing. Remember what you said. Are you on liquidity section? Are you on accumulated section?
Or legacy?
On legacy section. So you have to define very well. The beauty with this instrument is that they are what we call cash flowing. They have cash flows. Yeah, something like a bond. You'll not wait until maturity to get back your money. The way you'll buy a fixed asset like land, and until you sell it, that's when you cash in. No, they'll be paying you interest periodically, and that interest you can use to settle your obligations, which will help you. So there's a bit of some liquidity in it. Treasury bills are very short. Yeah, if you have if you lose money in 6 months, you can put in 6 months treasury bill. If you lose possibly next year or after 1 year, you can put in 364-day treasury bill. And that is how you're able to use for different uses. What we say that you have to define your goals, and your goal is not one. Your goals are many. So for whatever purpose you're investing that money, that is what then will determine the investment that you're picking.
Yeah. And it's good also for me to really insist on what Timothy talked about, compounding. Again, with treasury bonds, if you're disciplined enough to compound your coupons, we call them coupons, the interest payouts that the government gives, you'll be very shocked at just how fast you grow your principal
amount. And by
amount.
that, Joy is saying that if when you are paid interest, you don't consume the interest. But we are not saying you don't consume. If the intentions of this money, for example, if you put this money and say, the interest, I'll be using it to pay school fees for my kids, that is fine.
That's okay.
Because at the end of the day, we are trying to achieve your objectives. But if then it's for accumulation, you don't want to consume the interest. You want to deploy back the interest. You want to deploy back the interest and invest more. If the money is not enough to possibly buy another bond, because you need a minimum of 100,000 for these treasury securities, then you can put it in a money market fund, wait for the other interest, combine, possibly add more, and buy more bonds. Yeah.
And it's good to mention, I think for me from experience, what I like most about bonds investment is the fact that it gives you capital preservation.
That is it. At least if you're disciplined enough for inflation, I was even as surprisingly, if even as a basic example, do you know that if you're disciplined enough to compound, you'll double that money at a rate of 15% within 5 years. Within 5 years, you can double your money. So and that doubling, possibly, I know people will talk about the value of money, yeah, the time value of money, but then that is how it shields you, because your 1 million today in 5 years will be 2 million. So you can't tell me that your money will have really depreciated so much or eaten by inflation.
You're like hedging against
inflation.
It's
like hedging against inflation. Yeah. But again, if it's for use, I usually say this, Joy, that money cannot, or the money that we have, there are things we'll do with it that cannot be
postponed or avoided.
Exactly, or not even avoided, that you cannot measure.
Yeah.
Some returns in what we do with the money cannot be measured in terms of monetary value. So we are not telling you to prioritize the reinvestment other than thing. And I tell you an example. Your dad took you to school. You cannot equate the school fees they paid with any return. So it's also good to...
It was also an investment.
It's an investment, and so you can't say that I'll not take my kids to a school because I want to compound. Or you cannot, you will not reinvest in yourself. Possibly you want to do a higher course. Or
I think it's good to mention that sometimes the investment is in money. Sometimes the return is not always monetary.
Exactly.
That's
the
what
returns
Timothy
are not
said.
monetary.
Yeah.
So a lot of people are fixated with the monetary return. But life is not about money. Money is
all the time.
It. And a lot of the best return is not the monetary return. You have a family. You bring them in a good way. The beauty of that family cannot be put in monetary terms. That it is worth $1 billion shillings. No. And remember, what you're investing is after what you have consumed, because we are living human beings, and we have to meet obligations, and you have to spend because we have to, just live life. That what you're investing is. So stop looking at everything from the lens of returns. It's good to look from the lens of value, and value is not always monetary, like you've said. Yeah. So those are two things. So there's a bond, there's a treasury bill. Bonds are in two categories, actually. Possibly you might have a lot of people talk about infrastructure bonds, fixed coupon bonds.
Yeah.
The only difference between those ones is that one is tax exempt. The tax implications. One is tax exempt. The other one is not tax exempt.
For now.
Yeah. So you'll be charged some element of tax, 15% withholding. But for infrastructure bond, the interest is 15%, 150,000 will be paid to you.
That's net.
Deduction.
Yes.
That is net. So especially for all of us who are taxed in other areas, it would be good to then invest in
take
one
advantage.
That is not taxed, because it's called tax avoidance. Yeah. Avoiding tax is not illegal, I mean. Yeah.
We're not even avoiding it. We are not being taxed.
Yeah, exactly. It's just a way of
it's an opportunity.
It's an opportunity that government has given you not to
pay tax.
Yeah. And then we go to the other vehicle that is mostly known, which is stocks, and other elements that trade at the exchange, which are stocks. These are shares. Shares are what I'd call medium risk kind of investments. There's risk that you might lose your money. Yeah.
Yes.
And if there is a risk that you might lose your money, then it requires you to be more cautious when you're approaching it. Because how do you gain money when you're investing in stocks? You're buying a portion or a part of a company.
Shares.
And so your share value is dependent on how good that
the company is performing. Yes.
So if you bought a certain stake and the company does not perform very well, the share goes down. And the reason why share goes down and up is because of what we call supply-demand dynamics. So if the share is not performing well, so there's not much demand, so people will just dispose that share and you might lose your capital. And again, if the share does well and the company does well, performs well, then the share goes up. So the differential between the price you bought and the price you sell, that is your gain. But also, companies that do well also give what you call investors some dividends. So that is another
way of
return,
making, it's like a bonus.
It's like, after part of the profit, they'll pay to
share with you.
investors.
Yeah.
For something we didn't talk about when you talk about bonds, treasury bills are almost tax risk free. I mean, there's no opportunity unless, I don't know, it's risk free. What you're saying, there's no risk, but there's minimal risk that you can lose your money. Treasury bonds, on the other side, is that the price of a treasury bond is determined by the interest rates. and there is an inverse relationship between the interest and the interest rate and
The yield.
the price. Yeah, it's called the yield.
Sorry.
So what we are saying is, if you are holding a bond to maturity, and that is the reason why you need to be really define your investment horizon. If you are holding a bond to maturity, you don't
Those
face
factors
any
won't
risks.
affect you.
Won't affect you. But might you want to buy a 10-year bond and you want to sell at year 3?
Secondary market.
The question of the price will come in, and the question will be, where are the interest rates now? If the interests have gone higher than when you bought them, then the value of your bond will have come down. Not a lot, but slightly.
It's substantial.
Depending on how much the interests have gone up. Yeah. So it's very good to understand those dynamics. And even a lot of people don't understand why that dynamics. So if I can take 1 minute to explain. If today we buy a bond at 10% interest, okay? And these bonds, then when they are issued at central bank, they are listed at Nairobi Securities Exchange, where they can sell and buy to each other. Now, the bond is at 10%. Then assuming next year the interest goes to 15%. Now, for me to sell a bond with interest of 10%, when interests are 15%, I have to compensate that investor who is buying a bond from me. Because that investor has an opportunity of buying a bond of 15%, but if he buys mine, he will buy at 10%. So I have to discount that bond to be equivalent to the way he could have bought a 15% bond. That is why when interests go up, the new bonds that are being issued with high interest becomes more demanded, and the ones that are issued previously with low interest becomes less demanded, and so you are forced to sell at a discount. Because remember, this is a willing buyer, willing seller, and capital is unforgiving, it's not emotional, and they chase the best returns.
The return, yeah.
It's good to explain that. Now, so when you come to bonds, they are not risky. They're still under the low category of risk. But again, these are treasuries. They are still under the low category of risk, but again, they are susceptible to interest rate spikes. And on the same bonds, you don't have to, it's not necessarily a bond is issued by the government. We have what we call corporate bonds. A corporate company can issue bonds and people can subscribe, and they still operate the same way, only that if they're issued by a company, the security or the risk is then dependent on how good is that company, how solid is that company.
So it's more risky than
it's
a treasury.
More risky. That is to say that because
that's what Timothy said.
Yeah. So when we go to let's go to
the asset classes.
Asset classes. We talked about stocks. There are stocks. There are what we call commodities. Commodities are the normal commodities that you know. I think the most known commodities: gold,
wheat,
copper. There are a lot of classes. There are farmed commodities like pigs, even beef trade in global markets. But in Kenya, we only have one commodity that trades. It's called gold. There's a gold ETF. If you want to get exposure to gold, when you're buying this instrument, what you're trying to get is exposure. So you have an idea that possibly this commodity will do well in a certain period of time. That is when you buy the commodity. But a lot of people who buy these commodities or trade in commodity markets, what they do is hedging. The reason you buy commodity is hedging. So if you're a farmer and you're farming wheat, you don't want to be susceptible to the prices of wheat because wheat will take like 6 months to mature and harvest. You want to lock the price today because you know your cost today. So you go and sell those ones in terms of contracts in the market. And so the people now start trading them. So possibly the person who is buying that contract is person who has possibly a bakery. He wants to lock the price of the future.
Now.
So it's more for hedging. He wants to be sure of the price today. But again, in any market, people will always speculate. So between the producer of the wheat and the user of the wheat, who is the bakery, there are people who want to speculate. They will buy those contracts because they think, wheat will be scarce, the climate conditions will be worse, there'll be a change, so the harvest might dwindle or something, the supply will be constrained or something. So those speculators will again, trade within themselves. But the reason why this market exists most of the times, and the biggest reason, is hedging. Yeah. So even gold, the reason people buy gold is to hedge against possibly the volatility of currencies and all that. Yeah. So you're hedging against something else, and that is why in finance there is a very mostly used word. It's called the correlation. So when you're trying to invest, you don't want to invest in correlated product because the correlated means that the price moves in cycle. That if this one goes up, this one goes down. No, you want to have a diversification where if one goes down, the other one goes up, so that you're not exposed.
Yeah.
It hedges your exposure or reduces your losses. That's what you mean by hedging. There's the currency market. You can trade forex. That is a topic that requires another
A whole
episode
class.
altogether.
Yeah.
When you're trading currencies, but you need to be a professional trader. There's I need to restrain myself really in terms of advising and educating people on how to go about it. I think we'll make a whole different episode on it because there are a lot of
nitty-gritties around
lies being spewed around, and you need to know how to do that. But that is one. Another one. The other one is even other asset classes, like even crypto. People have assumed it's an asset classes. And how do you do this? How do you then invest? These are very complicated investments. How do you tap into them and you don't know anything about them? Try first to reserve yourself to not invest in what you don't know.
Understand.
And if you really, there is FOMO, Joy. There's FOMO.
We talked about it.
There's a times that, have you ever been in a situation where everyone is making money, you are the only one who is not making? So how do you then approach this?
Yeah.
Like everyone is talking how they made money. Is to look like your investment portfolio and say, okay, I can lose possibly 5%. What is the worst? I lose 5% of my wealth. That one I can live with. Remember the ability to take risks.
Yeah.
If it works, then the upside is unlimited. I don't know why. I'll be lucky.
Yeah.
So those are the conversations I need to have. But it is very good. Don't invest in what you don't understand. Let no one convince you that I told you, anyone telling you they are making money in something, high chance they are lying to you, because no one has a formula of how to make money. Yeah. So you do what you understand. That is the basics. Yeah. And lastly, as we tail this off, I want to tell and advise people, if you don't understand anything, keep your money. The worst it will happen to that money is lose some bit of it to inflation.
Yeah.
Inflation will not eat everything. People are always acting like it's urgent to put this money somewhere. There's no urgency. Take your time, take even 1 year to very well understand what you are getting yourself into.
Yeah.
Let no one tell you like it's urgent. These are, the way people sell things that only 80% sold. No, there's nothing sold here. The markets will be there even next year, but one. Stop acting like the urgency, like if you don't invest today that you lose your money. No. Your money in the bank is safe. The money you have is safe. Keep it until the cost is clear, until the excitement has gone, until you have a rational mind to make a rational decision. Not driven by influences. Even when you are fed up with information by your friends or acquaintances, don't go and act. Let the information fade, make a rational decision. If you don't know how to go about it, contact an advisor who is not selling you anything, who is there to advise you of how those things work.
All right. Thank you, Timothy. And probably just mention something around real estate and rates as also an investment class. Ndio tusiulizwe na watu wa mashamba, mbona hamkusema maneno ya mashamba?
Actually, real estate is also a very good asset class.
Yeah.
I know traditionally here we have known real estate from a point of like I can buy land
Direct,
on an apartment,
direct
which
investment,
is okay.
yeah.
It's a good investment. You can buy an apartment and then have land. You can buy land, it can appreciate in value. Those are what you call traditional kind of asset classes. Real estate nowadays has been unitized.
It's evolved.
It has evolved. And today you can buy a real estate or you can get exposure to a real estate and not having a land or an apartment. Yeah, it's called real estate investment trust. And to say this, most of these investments that you do, all you need is exposure to that asset class, because you're not looking to ownership. You are looking for the return out of the way you have invested your money. The only real estate you look at possibly from ownership is home ownership. You want to own a home, but beyond home, you don't need to own an apartment if there is another way that you can still get a return without you owning the title. Yeah. And so there's in real estate investment trust. How do they work? What happens is that monies are pooled. You remember what you call collective investment schemes? Money are pooled together. So we have two types of real estate. We have a development rate and an income rate. If it's a development rate, we'll pool money together. We will go and build houses, and then we will sell those houses, and the income that comes or the profits that come from that construction when you've sold, we distribute it. Yeah. And that is our model of business. When we come to income right, we are not looking to construct. We say we will buy or we will purchase income generating real estate or apartments or malls. Once we correct rent, we distribute to the unit holders. That is what we call an income rate. So they're in two types: a D rate, an income rate. In Kenya, I think there are several rates. There's Fahari Highlight. It was listed at
listed on
Nairobi
NSE.
Securities Exchange.
Yeah.
Econ, the hostel companies have
Econ, yeah.
Econ, they have a rate. I think they have a D rate and an income rate. And others are still coming into the market. So be on the lookout. So you don't necessarily have to own like a home or a title to invest in real estate. You can be a real estate mogul or investor for that matter, but still not own, because what you need is exposure to that asset class.
All right. Thank you, Timothy. I think we have tried to extensively break down the investment opportunities that are very common in Kenya or in our country or in our market currently. And I would really request us that we ask questions around it, because we have quite a number of notions around them out there. Ask us on the comment section. Let us know the clarifications that you want, any queries that you have, anything that you've been told that you'd want to clarify. We will be more than glad to do it. But there's something that Timothy said, and I want to conclude with it because we had covered it in our previous episode. Group thinking. Group thinking. With investment opportunities, it's not one size fits all, because one, we don't have the same investment objectives, we don't have the same goals and horizons, and even to bring it to bare minimum, our ability is very different. Our risk appetite, our risk tolerance is very different. So sit down as an individual, and we talked about even saying no, for example, to different group investments. Remember, again, it's good to understand what it is you want. So, for example, if you get in a chama where you're investing in flats and apartments and you're looking for liquidity, right there you might have an issue. So sit down as an individual, even as you pull funds in collective investment schemes, even as you invest in the different asset classes that we have described with Timothy. What works for you, what works for your goals and for your objectives. So thank you so much. Again, remember to share with your friends these episodes, comment, subscribe, so that we keep these conversations going. We're really grateful for the feedback that we continue to receive from yourselves. And until next time, see you then. Bye-bye.